January stocks always a smart buy? Well, let's take a closer look at this idea and see if there's any truth to it. You've been misled about stock market seasonality. The notion that certain months are guaranteed winners is just another money myth, and here's why. No month or quarter consistently outperforms the rest year after year. However, there's a twist. Investors often exhibit predictable behaviors, which can create seasonal trends in trading patterns, but these trends do not guarantee profits. Let's start with January. It sounds fancy, but it just means that after a holiday lull, investors jump back into the market as trading resumes for the year. But here's the boring truth. While there have been some periods where this effect appeared to hold true, statistical analysis over decades shows that it hasn't been consistently reliable. Think about this. Since 1950, January has seen an average return of around 1%, which might sound good. But is it really? Let's break it down. Over a long period, every month averages out to roughly the same returns. So why do people think January is special? The answer lies in our brains. We perceive patterns even when they don't exist, hoping for order amid randomness. This is akin to remembering all your winnings at a casino while forgetting the losses. Now, let's talk about March. You've probably heard the phrase "sell in May and go away," which suggests avoiding stocks from May through October when trading volume is thought to be lower. However, this is another myth that gets repeated year after year. The idea is that during these months, markets tend to be slower because traders are on vacation or less active. But again, this isn't a reliable strategy for predicting market performance. Here's the data. Over the past 50 years, the S&P 500 has shown little difference in returns between May-October and November-April. The average return during May-October is about 1%, compared to around 2% for November-April. So while it might feel like the market is sleepy, you're better off sticking with a long-term plan. But why do people believe these myths? It's partly because we love stories more than numbers. We seek simple answers and quick wins, but investing isn't that straightforward. The plain reality is that consistent long-term strategies outperform chasing seasonal patterns over time. Let's look at the numbers. If you had invested $10,000 in an S&P 500 index fund from January 1970 through December 2021, it would have grown to over $1 million due to compound returns. But if you tried to outsmart the market by timing your buys and sells based on months or days, historical data shows that you'd likely lose money due to increased transaction costs and reduced holding periods for gains. So why do we still believe in stock market seasonality? Our brains are wired to detect patterns, but not all perceived patterns actually exist. The excitement of trying to beat the system feels good, even when such strategies don't work consistently. It's like thinking you can outsmart a roulette wheel with a betting system. It just isn't possible. Now let's dive into why our behavior matters more than market myths. When we believe in seasonal trends, we tend to make decisions based on hope and fear rather than on factual analysis. This can lead us to buy high and sell low, which is generally not advisable. Here's a concrete example. Imagine you're looking at a chart showing high returns in January and lower returns starting in May. But here's the problem. Those patterns are random. Just because something happened once doesn't mean it'll happen again. Let's talk about fees for a moment. If you're trading based on these myths and paying high fees every time you're losing money, a 1% fee might not sound like much, but over decades it can significantly reduce your returns due to the power of compounding. For example, if you start with $10,000 and earn an average annual return of 7%, after 30 years without any fees, your investment would grow to about $76,122. However, with a 1% fee each year reducing your net return to 6%, the same initial investment grows to only about $43,700 over the same period. That's real cash that could have been invested elsewhere. Now, let's restate the core question. Do these seasonal patterns actually help investors consistently make more money? The answer is no. Here's why. January effect. Despite common belief, January's average returns aren't notably higher than those of other months. Sell in May and go away. This strategy isn't consistently effective. Market performance isn't tied to calendar patterns or vacation periods. But here's the part the industry doesn't advertise. When you try to outsmart market patterns, you often fall into traps like emotional decision-making or prioritizing short-term excitement over long-term gains. It's like chasing after shiny objects instead of building a solid foundation. So how can investors understand stock market seasonality and its impact? Focusing on consistent investing is key. Here are some educational points to consider. 1. Invest regularly. Put money in the market every month regardless of short-term fluctuations. 2. Diversify. Spread your investments across different types of assets like stocks, bonds, and other securities to reduce risk. 3. Stay patient. long-term gains come from staying invested through various market cycles. Let's look at a real-life example. Someone who started investing $500 a month in January 1980 would have seen their portfolio grow significantly over several decades. But if they tried to time the market, they'd likely miss out on those long-term gains. Now, let's talk about investor behavior again. We often make decisions based on gut feelings rather than facts. This can lead us astray when we should be focusing on solid strategies like dollar-cost averaging, which involves investing a fixed amount at regular intervals to smooth out the impact of price fluctuations over time. The math is clear. Sticking with consistent investing outperforms chasing seasonal patterns. Why do people still believe in these myths? It's partly because following them can make investors feel smart, even if the strategies don't actually lead to better decision-making or returns. Here's a concrete takeaway. Remember that every time you consider buying or selling based on the month, ask yourself if this aligns with your long-term investment strategy. If it doesn't, pause and reconsider. So what have we learned? Seasonal patterns in the stock market are largely mythical, but our behavioral responses to these perceived patterns can be detrimental. Here's the practical reality that surpasses the enticing myth. Consistently investing is the most effective approach to growing your wealth over the long term. To wrap up, you've just learned why stock market seasonality isn't reliable and how common investor behaviors can hinder sound financial decision-making. Remember, avoid letting misconceptions influence your investment choices and focus on maintaining a well-thought-out strategy. This is educational and historical, not financial advice. The idea that certain months or times of year are better for buying or selling stocks might sound appealing, but it's like relying on astrology to make real-world decisions. For example, the January effect suggests higher returns in January, yet studies show mixed results over time. Let's look at some more ways our behavior can sabotage our investment goals. For example, many people believe in the January effect, the theory that stock prices tend to rise in January after declining late in December. However, studies show this pattern has become less reliable over time as markets have evolved and investors have become more sophisticated about exploiting it. So while you might think you're catching a trend, you could be falling for an outdated myth. Another common behavior is selling stocks when the market crashes. Panic is our brain's way of trying to protect us from danger. But in this case, it often leads to locking in losses and missing out on potential recoveries. Think about how many times you've seen a stock or the broader market drop sharply only to rebound shortly after. Selling during downturns can cost you significant returns over time. Let's talk about another myth, the idea that certain days of the week are better for trading. Some say Mondays are bad because people sell off from the weekend's news, while others believe Fridays are worse as traders cash out before a long weekend. The truth is these patterns don't hold up statistically over time. Markets move based on real events and company performance, not the day of the week. Now, consider how your emotions influence decisions like buying stocks right after they've risen sharply or selling them just as they start to drop. This behavior is called chasing returns, and it's a recipe for underperforming the market. When you buy high because everyone else did or sell low due to fear, you're letting your gut override logic. A key takeaway here is that sticking to long-term investment goals means avoiding frequent buying and selling based on short-term market fluctuations. Whether it's monthly patterns, day-of-week trends, or emotional reactions, such behaviors can harm your portfolio more than they help. So what's the boring truth that beats all this excitement? Diversifying your investments and staying disciplined. Instead of chasing hot stocks or selling at every dip, focus on a balanced mix of assets spread across different sectors and types of companies. Stick to a plan where you consistently add money each month regardless of market condition. This method may not be as thrilling as day trading or trying to time the market perfectly, but it works. Remember, this is educational content. For personalized investment advice, consult with a financial advisor. In summary, while stock market seasonality might seem like a shortcut to riches, relying on these myths can actually lead to poor decisions and losses. The best approach is to invest wisely based on facts and adhere to your long-term strategy. Remember, do not let fear or excitement drive your investments. Instead, trust the consistent power of disciplined investing. This is educational and historical, not financial advice. Seasonality patterns might give you a temporary boost if you time things just right, but they can also set you up for disappointment and risk. For example, many investors buy stocks at the start of January hoping to ride the January effect, only to find themselves in a market downturn that wasn't predicted by seasonal trends. Another common mistake is selling off investments during summer months, because some believe the market tends to slow down during this period. However, basing investment decisions solely on this belief can lead to missing out on potential gains when markets recover or perform well, often unexpectedly. It's also worth noting that significant events like elections or economic reports can overshadow any seasonal patterns and lead to sudden shifts in stock prices. Relying too heavily on seasonality without considering these factors can leave investors vulnerable. So instead of trying to predict the market based on seasons or guesswork, focus on a diversified portfolio with regular contributions. By doing so, you smooth out volatility over time and benefit from compound returns. Diversification and consistency might not be as exciting as finding that one perfect stock, but they're far more reliable in building long-term wealth. Remember, successful investing involves managing expectations and maintaining discipline. Stay committed to your strategy and resist the urge to react impulsively to short-term trends or market hype. Tomorrow on the Money Files, affordability of prescription drugs versus housing costs. This information is for educational purposes only and should not be construed as financial advice. This is educational and historical, not financial advice.